Good afternoon. Welcome, everyone, to our webinar, Going Beyond the Score to Transform Credit and Build Wealth, part of the Future of Wealth discussion series. Here at the Aspen Institute Financial Security Program, I have a small confession. We are nerds for infrastructure that will change people's lives. We've seen time and time again that the best ideas for solving consumer financial challenges are stymied when the rules and processes can't support the innovation that we need. And there is a lot of change in our financial infrastructure happening as we speak. For those of us who spend our careers working to make financial security a reality, now is the time to pay attention to the rules, the policies, and the technologies being built, like implementation of open banking rules that will unlock household financial data and potentially dramatically expand the credit landscape. I want to invite my colleague Erin Borge in here to have a quick chat with me because she's been spending some time going deep on this particular topic over the last year as we've been working on important issues that would shape a national strategy for a more inclusive financial system. So Erin, I want to ask you a little bit, as you've been looking into this issue further, how do you understand the role of credit underwriting in the financial security landscape? What is the problem we're trying to solve for real people?
Yeah, thanks, Kate, and welcome everyone to this afternoon's webinar. So part of this problem that we're trying to solve for real people is how people can financially thrive using tools and products in our financial system. And the work that we at FSP have been engaged in over the last several years is really thinking about how do people not just access, but use and benefit from a full range of products and services to reach long-term financial security. And credit is a huge piece of that. Credit has a role in financial stability and thinking about how households manage an unexpected shock to be able to access that source of liquidity. Credit also has a role in thinking about how people earn and keep income, because in most cities and towns in the United States, you need a car to be able to get to your job. So having affordably and reasonably priced credit is key to that income picture. And perhaps most crucially, credit is really key to some of the wealth building opportunities that exist in this country, whether it's investing in a small business or getting a mortgage to buy your first home and pass that wealth on to generations. So we see credit showing up all across people's financial lives. And we're really excited for this conversation today and hopeful to move this conversation beyond access to really thinking about how do we better price and bring more people into the credit market with new data and new tools and technology to be able to do credit underwriting in a really different way than we've been able to for the last several decades. So we're really excited about today's conversation.
Great. Well, it's also a fairly complicated ecosystem. And I know in designing today's conversation, we've tried to really kind of represent the range of players that are involved. Tell us more about who's going to be in the conversation today.
There's lots of folks that are in this ecosystem. And as you said, we're big infrastructure nerds at Aspen FSP. So this is not just a conversation about lenders and households. It's also about lots of other players who have different roles in this space. So some of the folks that you'll hear from in a little bit today represent really different parts of this ecosystem, from a credit bureau that's been testing how new types of data can impact scoring and who can be brought in, to a group that provides the infrastructure and the pipes and analytics for things like cash flow underwriting. You'll also hear from a technology company that allows people to connect their financial accounts to other fintech services. So you'll hear lots more about consumer permission data sharing this afternoon, and we've got those folks at the table too. And we have a mission-focused innovator who specializes in peer-to-peer lending, some of the oldest forms of lending in our financial system, whether it's captured in a formal way or not. And last but not least, we have a fabulous moderator for today's conversation and longtime friend of FSP, Evelyn Stark from Ideas 42, whose career in behavioral informed solutions will help us stay accountable and honest to make sure the solutions that we're developing in collaboration with the nonprofit, for-profit, and public sector will actually work and will actually be meaningful and be able to be implemented in people's lives and work for real people. So I can't wait.
I can't wait either. Thank you for that. And we also know it's not possible to have these kinds of dialogues without the support of our funders. So we wanted to also extend a special thank you for today's event in particular. We'd like to thank Equifax for their support of this webinar series, and we're also grateful for the support of all the investors in our inclusive financial systems work, which includes Edward Jones, H&R Block, JP Morgan Chase, the MasterCard Center for Inclusive Growth, Plaid, US Bank, Walmart, Wells Fargo, and the Visa Foundation. Now, I'm so excited. I'm going to turn it over to Evelyn and to our fabulous panelists. We're excited to hear what you have to say. Evelyn, over to you.
Excellent. Thank you, Kate and Aaron. This is a great kickoff. I am Evelyn Stark. I work for Ideas 42. We are a nonprofit behavioral design firm that partners with entities like financial institutions and fintechs and some of the folks that are here to really ensure that products are designed to enable people to make the decisions that they want to make. And as Kate already rightly said, this is a very complex landscape. And so this is what this team here is going to talk about. So I am going to ask each person to turn on their cameras, John, Kimberly, David, and Michelle. And then I'm going to start with you, John, if you can tell us a little bit about yourself and about your role in this credit ecosystem.
Sure, thank you. My name is John Finstermaker. I'm the Chief Data and Analytics Officer for Equifax's USIS business. And our role in the ecosystem is to provide data and scores to lenders to help them make credit decisions. Now, over the last decade, we've really put a big emphasis on innovating with alternative data to help lenders make smarter decisions and ultimately enable more consumers to have access to credit products.
Excellent. Thanks, John. Kimberly, can I go over to you?
Sure. Hi, everyone. I'm Kimberly Gardner, and I lead partnerships at Prism Data, a cash flow underwriting analytics provider. I started my career at Sears Credit, and that's when I first got passion for credit, for good or for ill. And I think I probably became a data financial services infrastructure nerd when I led the acquisition of a responsible credit effort into the Financial Health Network. So my career has really been focused on financial security, access to quality products and services. Great to be here today.
And then I learned something new about Kimberly's start. David Henderson.
Hi, David Henderson. I'm a fellow at Princeton University, visiting fellow at the Boston Federal Reserve Bank, and founder of Giving Credit. Giving Credit is a fintech supporting the oldest form of banking, turning to friends and family, and making and taking zero-interest loans. And so we take that data of the way people are supporting each other in trusted social networks, and then provide that to financial institutions to use in their commercial loan underwriting.
Fantastic. Thanks. Michelle, let's hear from you.
Awesome. Michelle Young, I lead the product group for our credit business unit at Plaid. For those of you who aren't familiar with Plaid, we are a leader in the open banking space, connecting over 12,000 financial institutions to thousands of applications and services, powering financial experiences from fintechs to Fortune 500 companies. Our mission within the credit group here at Plaid is to power access to more affordable credit. So this is very close to my heart. I've spent over a decade in my career working within the lending and risk space, using open banking to build lending products, and excited to be able to build products that can scale out to multiple lenders and really help impact consumers' everyday life here at Plaid. And I'm just super passionate about this space. I'm excited for this conversation today because I think we need to see more and more coverage about this topic and really drive some change here.
Well said, Michelle, and we're going to get more from you in a minute. David, I'm going to kick off with you with our first question, especially because you're looking at this a little bit differently. What are the limitations of traditional credit underwriting, and who gets left out of this story?
Yeah, it's an important central question. And the fact is that the system is exclusionary. That's not a political statement. That's just a fact. You have 45 million people in this country who are credit invisible. And so when you're locked out of mainstream access to credit, people are forced to go to payday lenders, which will extract $9.1 billion a year from low-income communities, mostly people who are Black and Latino, statistically more likely to be financially excluded. So when people are faced with this financial exclusion, they turn to their social networks to meet their financial needs. One study showed that 90% of low to moderate income individuals engage in lending and borrowing with friends and family, what I call community finance. And so through my work at the Boston Fed, I unearthed that US consumers may hold an estimated $200 billion in peer-to-peer debt. And so we're talking about this sort of peer lending landscape, sizable amount of money. And so people are showing their credit reliability in these networks. Yet when we say invisible, credit invisible, what do we mean by that? People aren't invisible to their neighbors or friends. Really, they're invisible to the mainstream credit system. And so to sort of situate us in this work, I'd point us to two books that I really recommend. One, a book called Creditworthy, which sort of traces the origin of credit reporting in this country. And so up till like the late 19th century, credit was really sort of through social networks. Also the book Debt, the First 5,000 Years, shows that this idea of sort of this corporatized, more digitized form of finance, which we've all been born into, is actually incredibly new. And so I'd say that people are showing their credit reliability when they lend and borrow with friends and family. And so what we need to do is expand who we see as legitimate data reporters, because people are showing their credit reliability. We're just not paying attention. We're just not looking at that, and we're not valuing that.
Thanks, David. And I do have those books on my bookshelf right behind me. Thanks. Kimberly, I'm going to jump over to you because David was talking about credit invisibles. And what are the key factors that drive this high number of people in the US, of adults in the US who don't have prime scores, which includes credit invisibles, thin files, damaged, and subprime?
Right. Thanks, Evelyn. So that's a really big, broad group of people, right? So we're thinking about all different kinds of folks. And so when you think about what goes into a traditional credit score, so if you're thinking about a FICO or Vantage score, that is based primarily, those traditional scores are based on data from your credit report, which includes information from your credit history. So do you have credit cards? Do you have auto loans? Do you have student loans? Do you have a mortgage? If you have those loans or products, what are your limits on those? Are you paying back regularly, or are you missing payments? If you have $1,000 loan that's revolving, are you taking $1,000 every month, or are you just using 100, that utilization? So all those different aspects go into the traditional credit report. So you think about, I'm new to credit. I don't have any of that information, right? So my college kid is constantly saying, Mom, why do I need to use this credit card, right? So, well, someday you're going to want a credit history, but not everyone has kind of the opportunity to get those credit cards or to be educated on how to use those. Or you think about instances where you maybe have a lot of credit, but you've had a financial shock. You lost your job, your family had a devastating medical situation, or something happened to the house, there's some emergency, the car breaks down and you don't have the cash and maybe you aren't able to pay for it. So then all of a sudden you're missing payments, your credit score is hurt, and then you're what we call subprime. So then you have this issue of how can I get quality products and services if I don't have a credit score, if I have a damaged, or subprime score? And what does it mean to be able to think comprehensively about credit worthiness? Because we know that the bureau information is, what's your willingness to pay? But there's so many other factors that go into whether someone deserves credit and what products and what price they should be paying for it.
Excellent. And we're going to jump into that a bit more in a few minutes. Michelle, how are emerging technologies and policies reshaping opportunities in credit decisioning right now? What's the view from Plaid on this?
Look, I think that we're in a super exciting time to be kind of at the middle of a directional change for the industry. If you think about things that are powered by emerging technologies like cash flow itself, it's not really a new concept. Assets and income verification, it's been around for decades. But how things operate, how consumers get access to credit, it's fundamentally changing. The concept of printing a bank statement out and handing it to your mortgage loan officer, like that's somewhat extinct. And so the thing that we really think about is like, why is the time now? Why is this different than it has been in the past? And I think outside of the work that we believe that we are driving at Plaid to create the infrastructure to support open banking, I think there's three key things at the center of the momentum. The first is really around consumer expectations are changing. Not only are the products available to them different than what they used to be over the years, but there's also a different sentiment to how credit is actually granted. We did a FinTech Effects survey recently, and it showed that 63% of consumers say that the credit scores just aren't enough to understand their full picture. The second thing around the momentum is really the regulatory space. We've seen policy stakeholders recognize the clear benefit of cash flow underwriting. And that it ranges from things like CFPB's 1033 rule to US Treasury's National Financial Inclusion Strategy, to ongoing programs like the OCC's Operation Reach. And so we're really encouraged that the regulatory stance, it isn't just a compliance thing, but it's now becoming a differentiator, really driving the cash flow adoption. And then finally, I think market expectations are changing for key players, for lenders that are looking to really create change and do underwriting and evaluate data in a different way than before. I was recently at Money 2020, and if you weren't talking about cash flow underwriting, I'm not sure what you were doing at Money 2020. It was a really hot topic. And I think all of these things coming together at the same time are really creating the opportunity to move cash flow underwriting out of the terms of like alternative data to something that's going to be as default as some of the traditional data sources that we've seen in the future.
Thanks, Michelle. That makes me think, Kimberly, you might have some thoughts also on this topic, especially around 1033.
Sure. Well, I really just agree with what Michelle said in terms of cash flow underwriting is the future of underwriting. You know, all these different data, and it's not that credit scores or the traditional ways are going to go away, but we've seen over time that there's been increases to alternative data, and I know John's going to tell us more about that. We also have, it's been hard, as like Michelle said, to quickly, efficiently be able to look into someone's bank account information and understand their ability and their willingness to pay. And so the ability to facilitate cash flow underwriting really helps facilitate that infrastructure. So, I mean, just as context, what we do here at Prism Data is we ingest data from any data source. So banks could be giving us information from their on us data, or a consumer could, when the application says it's the next step of your credit application, link your primary bank account, the one where you get your income. They can link through Plaid or another aggregator into their bank account. And practically in real time, that information is available for us. And we look at that information, we categorize that messy transaction data, we provide thousands of attributes that can be used as credit decisioning, and we have multiple cash scores. And so those cash scores help quickly assess the willingness and ability that someone has to pay, or really what the likelihood of their default might be as someone implements that from their credit underwriting perspective. So we have these tools at our fingertips now to practically in real time be able to assess credit and creditworthiness.
Fun. Thank you. I'm going to ask John to put you, I think you have a few slides to share, and I would love to ask you to do that at this time. And actually, before you start, John, I have just remembered, I want to ask all of the audience to also participate here. There's a Q&A button on the bottom of your screen. So while John's talking or as other ideas or thoughts come up, please feel free to jump in and use that Q&A button.
Yeah, so if we jump ahead to the next slide, when we talk about alternative data, and the other panelists have already touched on cash flow data, you know, what are some of the things that Equifax has been doing around alternative data? The first is specialty finance data. Think short-term installment loans, rent-to-own, lease-to-own type information. We've got this type of data on about 80 million consumers at Equifax. We also have telecommunications and utility payment history data on about 200 million consumers. When you think about the credit invisible population, as well as other thin file populations, many of them have cell phones, they have utility bills, You start to track that payment history, and you can get a really good indication of whether or not that consumer is going to be able to pay their loans back on time. Just looking at those two sources alone, we find that we can score up to 32% of credit unscorable consumers. Now, cash flow data, as the other panelists mentioned, a lot of promise there as well. We've been doing a lot of research around cash flow data. At a bare minimum, that 32% jumps all the way up to 60%. We think it's well over 60% when you bring in cash flow data and get that consumer consent to use that in credit decisioning. So why is this important? If we jump to the next slide, just looking at the census counted population, traditional credit data are a good foundation, but many consumers are left behind. Out of that census counted population, 15 million completely credit invisible, not on the file at all. Another 10 million are on the file, but they are unscorable because of the limited information on the file. Another 50 million are scorable, but they're scorable with very thin file information, meaning there's a lot of opportunity to supplement the data in the traditional credit file and make a better decision that's more likely to lead to access to credit for those consumers. So you add that all up, that's 76 million thin file or invisible consumers where that alternative data can really make a huge impact. So when we go to the next slide, we can really see what that impact looks like. When we look at just the traditional credit file, you've got a little over 60% of consumers who can credit qualify for prime or super prime lending products. When we start to layer in these alternative data, we see those numbers start to increase with the utility and telco information, with the specialty finance information. We can also use advanced modeling techniques to make better use of the data we have available to us. And we start to layer all of those things on top of each other, we see huge increases in the populations that can qualify for traditional lending products. We see 16 million more consumers able to qualify for super prime lending products. 10 million of that 16 is attributable directly to these alternative data. When you look at prime or better offers, 13 million incremental consumers able to qualify for those types of credit products. 11 million out of that 13 million is directly attributable to the alternative data. So a lot of opportunity here, both for lenders and consumers in terms of access for credit. So if we jump to the next slide, and this really just, the traditional credit reports are definitely a strong foundation. But whether it's some of the data we have proposed at Equifax, as well as cash flow data for cash flow underwriting, a lot of opportunity to really help consumers build wealth and access credit products that maybe the traditional credit file does not enable them to access.
Thank you so much, John. I'm going to start with a question for you, and then I'm going to ask the other folks to answer it as well. I'm trying to merge a couple questions that were in the Q&A, so forgive me if I make it a little messy. But a couple things from things that all of you have said, but all of this alt data, it already existed. It's existed for a while, right? So why haven't we done this already? Something Kimberly said was people can attach their PLAD to their credit union, and then their data can look at it. How are people supposed to know how to do this? What's going to make it easier? And then I'll let you start there, and then I'm going to ask everybody else about some of the trade-offs and difficulties that are involved as well.
And to me, the biggest barrier to adoption is just the disparate number of scores and decisioning mechanisms. If these data have existed, these data have been for a decade plus baked into certain credit scores, but they're not baked into all credit scores. So many of the credit decisions are based on scores leveraging only the traditional credit data. So it's really building an ecosystem where all of these disparate data sources can come together across all the various credit scores used for decisioning to ultimately yield that access to credit for consumers.
Great. And what do consumers have to do do they have to do anything directly with Equifax to make this work?
So for the data we already have proposed, the telco utility data, the specialty finance data, consumers don't have to do anything. Those are furnished to us, just like banks furnish the traditional credit data to us. We have furnishers who furnish those data to us. Certainly, as we get into cash flow underwriting, and I'll let some of the experts touch on that even more, we definitely need that consumer consent to be able to pull that information in for credit decisioning.
Right. And I'm going to invite Michelle, David, and Kimberly to come back on video on this as well. So, I mean, I would love to hear how, building on what John's talking about, what are some of these trade-offs for including this data for consumers, for lenders? And Michelle, let's start with you.
Yeah, I think it's really about creating an optimal experience for a consumer going through or a borrower going through the lending flow and being able to have that as an option. As Kimberly talked about, as John referenced, like traditional credit data isn't going away, and it is a great measurement in terms of willingness to repay. And this is just another mechanism to look at a borrower on a holistic perspective. And so lenders are really at the center of enabling this, bringing these types of experiences in. And then I think from, an open banking consumer world, the ability for a consumer to understand and have that control to actually share that information and really be able to have a voice in the credit decision.
Excellent. Thank you. David, I would love your perspective from the consumers that you talk to on this.
Yeah, I mean, if we talk about this really just from the perspective of financially excluded populations, which is my focus, the biggest risk is the status quo. The exclusion is wide and it is racialized. And so each of sort of the different innovations around cash flow or rental or utility or what we're doing in community finance, I think all of these things are welcomed. The status quo is so bad that there's kind of only up from here from a standpoint of financial inclusion.
Just to piggyback off on that, one of the things we really see is that when customers understand why they might be permissioning access to, say, their bank account data, they're very often motivated to do that. So if I'm excluded from traditional credit and I'm trying to get a higher quality product and service, if I go to a trusted credit provider and they say, link your primary bank account because we can help you get a better rate or get access to a larger line than you have, customers are very motivated to say, yes, I want to opt into that information. And so I think one of the things we sometimes hear about is the concern of adding friction for customers to be able to link their account. Now, I think the challenge or the trade-off we have is the industry moving fast enough. So I think, I heard NPR stories on 1099 or 1033, 1099, 1033. And so I think more and more customers are understanding, hey, people actually can look at my bank account data, make a credit decision. But how do they know where to do that? Which companies are doing that right now? Is that public information? So I think the more we see adoption and faster adoption in the industry, the more we're going to see those customers benefit that David and others, that many of us really care deeply about.
Excellent. Let me take some of the questions from the group. You've answered some of these, but let me ask you this one. Are there any concerns or considerations for the possibility of cash flow data becoming proxies for demographic groups that could then result in disparate impact? Kimberly, can I start with you again since you're on my screen?
Sure. So one of the things we really spend a lot of time thinking about at Prism Data is fair lending, is all the critical aspects of making sure we are following the strong regulations and having access to high quality products and services that are indeed following the regulatory landscape. That was kind of a weird way of saying that. But the other thing I would point you to is FinReg Lab has done great work on this. FinReg Lab has looked very deeply at exactly some of these issues and have found that, in fact, there is not a disparate impact from people linking their bank accounts. In fact, it increases the ability for those customers that we care about to be able to have access to quality products and services.
Excellent. Does anyone else want to take that question on, which has moved away from me? Here it is. David, are there concerns from the customers you've spoken to about cash flow data becoming proxies for them that could be used negatively?
Yeah, I mean, I kind of go back to my first answer that disparate impact is the status quo. And my experience really mirrors a lot of what Kimberly's saying as well. The one thing that I will say, especially as you're focusing in financially excluded communities, is that these are people who are used to getting ripped off by the mainstream financial system. So I do think there's sort of elements around trust, but in terms of sort of like risk to the individual, it's the status quo that is the risk, not any of the innovations we're talking about here.
Excellent. I mean, obviously, this kind of trust and ambiguity is something that we deal with a lot in behavioral science. As we're transitioning into this space, I would love to hear, I'm going to go with Michelle and then John. How do you show people that it is worth sharing their data, that their data is being secure? How do you demonstrate that?
Yeah, I can take that one first. I think the thing that we've always thought about from a consumer perspective at Plaid is that we want to be in the relationship. We want it to be transparent that you are, as a consumer, using Plaid to connect to your account. We've done different user research with individuals kind of looking at the sentiment towards using this data for qualifying for a loan. And we've heard, oh, Plaid, like the person who helps me connect my bank account to Venmo. And so I think for us, likely this isn't the first time in a lending process that a consumer has maybe seen Plaid before. And that is really critical to us in that consumer experience and how we drive that. And I think that, we're also seeing as consumer kind of sentiment and expectation changes towards traditional data sources, we're seeing that they're also becoming more and more comfortable with the ability to share data. We did a survey that showed that 72% of loan applicants are comfortable sharing that bank data. And so as they're starting to interact with it in different places, I think it's really creating kind of that effect that we're going to see them feel more and more comfortable in the loan application process. And I think the goal is also to not have it just be, certain individuals, but also something that can drive impact across all people qualifying for credit.
Excellent. Thank you. I'm going to bend that a little bit, John, and just ask you about other forms of data that in the alt data that you shared, how consumers share that, what the implications are, how they know they're sharing it, et cetera.
And with those data, I mean, we are not getting the data directly from the consumers. It is coming from furnishers. But then we do want to actively promote that. We want to make sure that consumers are aware that these credit reports exist and that they're able to go look at their report and understand what's there, dispute any information they don't agree with on that report to make sure it is accurate and reflects their payment history on, say, their telecommunications account. So it's really about getting the message out there so consumers understand they still do have control over these data in the sense that they can go review the information, dispute any information there, and make sure we've got an accurate reflection of their credit history.
Excellent. Thanks. David, I'm going to come back to you. We heard about some of this data that can be used, and we didn't hear about how you can share Bank of Mom, as I used to call it, how you can share that data. So can you talk more about the work that you're doing on peer-to-peer lending, and how is that power of community level data? How can that be used for transforming wealth building?
Sure. So our focus with giving credit is on financial inclusion. And so our perspective on that is that requires a new type of data. And so what we're building is the credit reporting agency for community finance. And so I quoted earlier that my work at the Boston Fed, in my paper, I estimate that U.S. consumers may hold up to $200 billion in peer-to-peer debt. So that's zero interest loans between friends and family. And so what we're focusing on is aggregating that community financial data. And so the way that we do that is we have an application that people use for zero interest lending with friends and family. But we're also working on a way for people to be able to permission their bank transactional data using Plaid to identify reciprocated peer loans in that data. And so I want to highlight that while there's really great innovation in cash flow underwriting, I think there's different ways we can think about accessing that bank transactional data and creating new data from that. And so what we do is we surface that data for financial institutions. Our perspective is that people know in their network who's a good credit risk. And so we're piloting with CDFIs and credit unions who are using our data for their commercial loan underwriting. And really what we're seeing is we're trying to bring about a future where, since community finance, we'd argue, is more inclusive, but mainstream finance has more capital. How do you bring those two things together? And we see Giving Credit as the platform for what we think will be future sort of intersectional products between community and mainstream finance.
Excellent. Thank you. I'm gonna switch on this for to move over towards implementation. So what are the challenges or the risks that arise when we're trying to integrate non-traditional data into credit assessments? And I'm going to start with you, Kimberly.
Thought you might. So if we think about what it takes to implement additional data sources, if I'm a lender, most lenders have very detailed credit policies, and these credit policies don't change very quickly. So one of the things we really need to think about is not just how do I get access to the new scores, the new attributes, the new bank account data, but how do I take that information and do I integrate it into my credit policies? Do I integrate it into every part of the infrastructure that brings that information into my credit decisioning algorithms and structures and tools? So it does take a lot of time. It does take a lot of reviews. It takes a lot of approvals, a lot of testing, A/B testing, understanding the impact over time. So I think if what we're talking about is the challenge, I think there's so many different places that we're touching, from policies to infrastructure to data, and it just takes some time. And I think there's a risk that we don't move fast enough in ways that can help the people we care about, and that continues to maintain the status quo that David's so appropriately concerned about.
Great. And David, I would assume that you agree with quite a lot of what Kimberly just said, and that's what you're doing with the CDFIs and credit unions that you're working with?
Yeah, that's exactly right.
Excellent. What about you, Michelle? What are the challenges and risks that you see?
Yeah, this resonates a lot because I have these conversations on a daily basis with customers. Like, how do we just get started using this information? And I think, like, to Kimberly's point, it's really easy to get stuck as a lender and like, I need all the data. I need to understand all the impact. I need to do an impact analysis. Like, I need to go through kind of the approval process and make sure I fully understand everything before I just get started. And that's inherent. Credit risk people are risk averse, as they should be. But I think our recommendation to the customers we work with is just get started. Pick a use case where you want to actually test out the value of this, and scope that use case to something that you're willing to really collect the data on and understand. And then as you see success of certain areas, you can continue to expand, be able to leverage things to actually have that data coming in on an ongoing basis, and maybe do your impact assessment through live data that you're not using to decision, but you actually can collect it over time rather than taking a few months or things to actually go back and try to look at a large historical population. And so that's something we're super excited about at Plaid, to really work with the lenders to find areas of opportunities that they can move fast.
That's really well said, Michelle. And I think we get excited when people already have some existing data from bank account information and credit outcomes, because it makes that testing and looking at the data analysis, it can expedite it. We see two different approaches for customers who are lenders who haven't been using bank account transaction data to date. One is some very large credit card companies or other lenders make the decision that if they're going to ask people for information, they need to use it in credit decisioning. So we see these real live pilots happening where we're working with them to understand what are cash scores, how can you set your cutoffs to start, how do you tune that over time? And out of the gate, we see large scale lenders making credit decisions and enabling additional access to customers they might not have before. So that's very exciting. Sometimes people also take that information and do shadow testing. They run it behind the scenes and think about, what if I had this information? How might I have made different decisions? And then they're able to quickly move that forward as well. So we see lots of different ways that people are testing and applying that are very exciting and encouraging.
So you both just talked about lenders being risk averse, as they should be, and shadow data, et cetera. But what confidence do they have from regulators that would support them in doing this kind of thing? And Michelle, Kimberly, John, anybody?
Happy to jump in. I mean, we definitely see that, there's a lot of different places we're seeing this, right? So from the CFPB, we've long heard them talk about the value of cash flow underwriting. And the new guidance that has come out really specifically gives clarity about how to be able to access these products and services and implement them. We know that the US Treasury has the National Financial Inclusion Strategy and specifically calls for access to safe products and looking at that bank account data. So there's been interagency guidance on cash flow underwriting, I think, since 2019. So this isn't a new concept for the regulators, and we're seeing lots of places where lenders are being encouraged to do it. We also have deep data that shows how valuable cash flow underwriting is, in addition to the credit bureau information. And so we have a lot of history and case studies that we're happy to share with people to help them understand that implementing this is really, really smart, and you can be able to better assess your credit risk.
I think Kimberly referenced all the great regulatory guidance that's out there. And it's funny because a lot of times regulation comes out and it can just feel like more compliance. I think in this space, it's amazing to see regulation come out that's really driving forward adoption, but it's also can be viewed as a differentiator that is actually calling for innovation and supporting that as people take a look at it, which I think is very unique.
Sorry, I'm going to try and there's many questions and I want to make sure that I get to them as well. Kimberly, can we ensure that expanding this access to credit leads to fair pricing of risk for underserved households, and demonstrate that this actually works not just for the lender, but also for the household?
Yeah, I think that's a really important point, right? So I think one of the things that we worry about, or that I spend a lot of time thinking about, is the mispricing of risk. So we think about people who are quite credit worthy, that are accessing products and services that are more expensive than they really deserve to get. And so, I know I'm sometimes accused of being, looking at the glass half full. And so, I think it's important to think about those risks and have the right safeguards in place. And I know with additional information that there is data that helps lenders be confident that I can give someone a lower APR or a lower rate, a higher line, and that they will be able to pay that back. So I think there's a lot of places where it's really promising.
So Michelle, let me take a question that's coming in and also ask on. So consumers will want to permission this data, as you guys have both said, because they want a loan. Is it more prevalent or better for certain types of loans than others, the cash flow data that you're looking at now? And then, let me leave it.
I mean, our belief is that cash flow data can have impact across all different loan types. I think because it is something that is new to being incorporated into different loan types, you're going to see different types of cash flow data. And we talk about it as like one big thing, but it's not just one thing. It could be, transaction spending habit. It could be a more out-of-the-box calculation for income or things like that, or as Kimberly talked about, a score that can be used as, a full representation. And so different loan types, I think, are going to have the desire to use different types of data. From a mortgage experience, it's having that income number as soon as possible in a more verified way to streamline the loan process. From an unsecured peer-to-peer perspective, it might be having things like a score or like a buy now, pay later loan where you can bring those things in and actually use them more quickly. And so in the end of the day, I think it really comes down to how lenders want to use this data. We see different use cases that come up from things like a second look underwriting. So, hey, maybe someone come in and had a no file or a thin file credit score. here is an opportunity to evaluate a consumer that traditionally lenders might have declined. Kimberly talked a little bit about pricing. We also see opportunities of allowing a consumer to share this information to help price a loan, because now there's another factor that can be used to really assess how that consumer can pay back. And then, ultimately, we also view that this should expand over time. So as we see progress in new use cases, as we see different loan types, identifying the type of cash flow data that drives the most value for them, we want to see a world in which this comes into first look underwriting. That's a part of every credit decision.
And actually, there's a lot of places where it is happening as first look or looks like first look. So if you think about a consumer going to a website and applying for credit, some of those customers will get approved right away. Some of them might get declined right away. And they don't necessarily know they're heading into a second look process. It might just say, as the next step of your application, link your primary bank account. So it doesn't feel like you're getting rejected in some way. It's just saying, here's some additional information that you provide as if it's part of the application. And I think that will help improve consumer trust and adoption, as well as industry usage as well.
David, do you see community level data coming into this same level as being on par with cash flow data or other alt data sources?
I think that's sort of the future that we're envisioning. I mean, right now we're much earlier than, with these discussions around cash flow underwriting. There's a lot more proof points around that. And so right now our work is pilots with credit unions where we're sort of testing out this type of data. And there's an intuition that it's the same behavior, that if I take a loan from my friend and I repay them $1,000, that's the same behavior as repaying a bank loan. But there is sort of an empirical burden to prove that data is equally predictive. And that's the process that we're starting now. Excellent.
I don't know how we managed to get through 48 minutes of a conversation without mentioning AI, but I'm going to do it now. And John, I'm going to ask you, can you talk a little bit about what you have been doing or been using AI to do, and what you're not using AI to do?
Sure, and I think this is important as well, that not only is it important to have more data for access to credit, it's also important to make better use of the data you have. And that's where we've really been focused with AI techniques. When you look at credit scoring, the first 50 plus years of credit scoring, almost every credit scoring model used a technique called regression because it met the explainability and the fairness requirements. Starting in 2015, we filed the first patent around explainable AI modeling techniques that meet the US regulatory requirements for credit scoring. So we've really been focused there on constrained, fair, explainable AI techniques for use in credit decisioning. Now, what we're not yet doing, because we don't have the ability yet to apply the right constraints and the explainability, is using generative AI for underwriting. I think there will be a time in the future where that is feasible, but there's a lot more work that has to be done around the explainability and fairness and constraints before we can really get it to the point where we're comfortable using it in credit decisioning.
Excellent. I'm going to ask anybody else to also comment on that. But before I do, I just want to remind folks to drop questions into the Q&A or the chat and join the conversation directly. But Michelle, Kimberly, David, comments or questions on AI?
Yeah, just the one thing I'd say on AI is that sort of for all of the focus and hype around it, it's only as good as the data that's available. And so if we're talking about consumers where we aren't collecting the indicators that show their credit reliability, then no model is going to be able to make up for that.
And I think to definitely plus one to both of those points, I think John's perspective on is AI going to be making the credit decision itself anytime soon? Probably not. Probably not in the next decade that we're talking about, but I can stand to be corrected in the future. But I think what it does help us do is help us better understand the data. And so I think some of the challenges with cash flow data specifically, it's really around accessibility, which I think is being solved as part of open banking, and then it's usability. How do you better understand the data that is in there? And that's where I think that we're going to see a lot of opportunities in terms of really understanding the usability of data.
Excellent. Let me take something Melissa just popped into the Q&A, which everybody else is also able to do. But since these are built on top of traditional models, what there is a difference between somebody with a damage score with a 560 because of past behavior versus a thin file. And so how much difference do you see for that? Like, what do you see as the ability for cash flow underwriting or alt data to do to somebody who has damaged credit?
John, do you want to hop in or you want me to go?
Yeah, I can jump in, and there's definitely opportunity with both populations, whether it's damaged credit or thin files. I do think it's a little easier. If you've got a thick damaged file, you know, the thicker the file, the harder it's going to be for the alternative data to really make an impact on that score and say, hey, despite this negative information, I've got this other positive information to pull you up. So what I found is historically the biggest opportunity is with thin files, but there is definitely opportunity with a damaged file as well, that maybe you had one bad trade or you had a rough period in the past, but then we see all of this other information. You paid your cell phone bill every month on time for a decade. That can certainly pull you back up despite maybe some hardship in the past.
Yeah. We have these beautiful tables where we look at the FICO scores across one place and the cash scores across the other. And so we can look very specifically at those swap in and swap outs. So if we think about someone with a thin credit file, what percentage of those customers have good cash scores and therefore make very good risks? You know, what people who have very poor credit scores or very low credit scores, let's call them, but have very high cash scores. Again, pretty good credit risks because we understand that their ability to repay is very strong. Likewise, there's people with very high credit scores who have very low cash scores. And so maybe you're lending to those people today and you shouldn't, or you shouldn't give them as high of a line. So I think if anyone wants to see those beautiful tables, I wish I could pop it up right now. I'm happy to go deeper on those after the call or another time.
Great. I'm cognizant of the time, so I'm going to give everybody a 1 minute, 1.5 minute. I'm going to ask you to do a quick round robin. 10 years from today, you're in a panel like this. And what does underwriting look like? What's the same? What's different for people and lenders, or people or lenders from your viewpoint? So what are we going to see different in 10 years? I'm going to start with you, Michelle.
Awesome. I love this question. Look, I think in 10 years from now, we are going to see cash flow data a part of every credit decision. And it is not going to replace traditional credit scores, but it's going to be a complement. And it's going to be as required as some of the things that we see today. And I'm really excited for Plaid to be at the forefront of that and help build a consumer relationship that allows them the ability and empowers them to share that information to create a more holistic financial picture.
Excellent. Who wants to go next? John.
I mean, I would agree that to me, we see that widespread adoption, whether it's cash flow, whether it's some of the other data assets we've talked about. We're going to see, widespread adoption over the next decade. I also think we're going to see other new emerging data sources. David's working on one. I think we're going to see more and more data sources popping up that start getting incorporated into credit decisioning. And we'll just see that the snowballing of the data available, as well as the snowballing of the adoption.
Great. David, you got called out there.
I was going to say, John, you set me up nicely. Yeah, I'd say, 10 years from now, if you think about today, the prominent mental model around finances. We have mainstream finance, and then we have alternative finance, like payday lenders and those sorts of finance. And so I would say 10 years from now, my hope is the lexicon is that there's mainstream finance, there's alternative finance, and then there's community finance. And that this data around peer-to-peer lending, the way that people are sort of showing their creditworthiness in these trusted social networks, is being surfaced and leveraged into the mainstream.
Kimberly.
I can absolutely +1 all of that, right? So we're looking holistically at a whole bunch of different data sources that help us comprehensively, help lenders comprehensively understand risk. And again, like Michelle said, it's very exciting to be at the forefront of that. Another enabler of this is the secondary markets and the warehouse facilities and others that enable the lending of credit. And so today, FICO is a primary way that is priced. And in the future, I feel really strongly that cash flow underwriting tools, whether it's Cash Score, we hope it's Cash Score, is being able to use to price that effectively. So I think when we think comprehensively about how we are pricing all aspects of the credit ecosystem, that cash flow underwriting will be a key part of that as well.
Excellent. Thank you, everybody. And because of everything that you're building and doing in 10 years, the behavioral science folks are going to be thinking, wow, look at this. They've changed the context in which people make financial decisions. They're hassle-free. They're trustworthy. They're not ambiguous. I get it. If I do this, then this happens. So congratulations in 10 years for making this a lot better for consumers. And thanks to the panel for all of your great insights and thoughts, and thanks to Aspen. And I'm going to turn that right back to Erin to do the closeout. So thanks again.
Thanks, Evelyn, and thanks, everyone. And I'll share my hope for the next 10 years is that children will not believe us in when we describe how credit underwriting used to happen, in the same way they don't believe we used to put things on floppy disks and send letters to each other. So that's my hope. Please join me in thanking all of our panelists. This is a conversation that we could run for another 3 hours, such rich information and surprisingly few acronyms. I only caught a couple. So I just want to applaud our panelists for helping bring us into a conversation that is going to take a lot of players to get right, from lenders to data aggregators to, perhaps most critically, consumers themselves saying yes to permissioning this data. This is an acute challenge, especially in a world where there's reduced trust in systems and an ever-growing call and rise of fraud and scam. So getting this piece right and helping consumers understand the potential value and savings to be able to price this risk differently, I think, is a key implementation challenge that we'll be watching over the next couple of years. But if the speakers on this panel are any indication, there's already been really great thinking about this. And we're really looking forward to watching this space evolve. This is one of Aspen FSP's priority issue areas. We're really thinking about this credit box and what it means for households' ability to build wealth. And as you've heard, there's so many great innovators in this space. So thank you all. There's information about the chat, in the chat about surveys, resources, lots of great stuff in there. Thank you all, and we'll talk to you soon.